As we are still at the early days of the new year, many are reviewing their portfolios and investments towards becoming wealthier. Now, after a very tough 2018 in stock markets, this year seems to be a little bit more promising, with some asset managers saying that 3 shares are definitely worth your buy. Dr. Adrian Saville, who is the Chief Executive at Cannon Asset Managers, joins me in studio to unpack those opportunities. Dr. Adrian, to me, thanks so much for your time. I mean, 2018 was horrific for most people. I'm just really interested, before we kick off with this conversation, in finding out how bad it was for you in terms of your fund's performance.
Our funds actually enjoyed 2018 better than most. Domestically explained by an overweight position in resources, and resource stocks in South Africa, well, really enjoyed the year, helped in part by currency weakness, global buoyancy in commodity prices. So whilst it was hard, I think there isn't an equity manager or an equity portfolio that can claim 18 was easy. We found 18 better than most.
All right, better than most. So I'm assuming you still ended negative, or,
yeah,
but not as negative as...
Exactly. You know, it's against the backdrop of a market that was down 10-15% domestically, depending on which index you're looking at. And if you go into the mid and smaller cap parts of the market, even worse. So negative, but not as bad as the broad indices.
All right, so obviously we're starting a new year now, and everyone is looking to not have another horrific year. Except when I look at some of the drivers that really did cut a lot of profits for most fund managers like yourselves, we are still facing very much of those issues in 2019. So how do you avoid...
We being the South African economy.
The world. I mean, when you look at geopolitical tensions, when you look at this ongoing trade dispute, when you look at Brexit that is happening today, and then against that, rising in US interest rates, although the Fed has signaled that it could perhaps be slower at that. Yeah. But yeah, all of those issues that we carried and that hurt stock prices in 2018, or most of them, correct me if I'm wrong, are still what we're confronting now.
I would agree with that. I don't think we've resolved any of those sort of grand red flags. Brexit remains a source of anxiety. I don't think Brexit is as real an economic impact as much as it's a talking point, but it remains a source of anxiety. Trump is determined to defeat, well, I guess, anyone. China happens to be in his crosshairs at the moment. So there's that ongoing trade war. You're right, the Fed has sort of calmed their tone, but at the same time the US economy is slowing down, and there really is an elephant in the room in the other part of that US-China story, and that's on the Chinese side of the equation, in the form of a massive mountain of debt in the economy. So there's no shortage of things to worry about. There never is, and at the end of 19 we'll know which ones we should have and shouldn't have worried about. But that's the world of investing. It's filled with uncertainty. There are always risks and traps, and it's our job to navigate and negotiate those.
Yet you are suggesting that we look at a company that gives us exposure to the juggernaut that is Alibaba in China.
Yeah.
I mean, so tell us a little bit about Alibaba. I practiced that so I wouldn't get it wrong. Alibaba, and I mean, its value proposition, but how it's insulated from the challenges in that economy that you've just described.
Well, Alibaba, as you say, you know, the shocking naming convention hints at an alternative to Alibaba.
All right.
Alibaba is well known. It's probably best known for its great success of Singles Day sales, 11th of November every year. 11th of November because it's 1111. It's all the singles. So everyone's single is encouraged to go online and buy themselves something nice. Last year they did $30 billion of through the till on a single day. And Jack Ma's business, Alibaba, has grown to be the largest online platform globally. So although it is Chinese footprinted, it is increasingly outside of China, and it's also multi-industry. It's not a single industry, you know, just digital channel. It owns a football team, a film business. Inside of Alibaba, there is also exposure to Yahoo Japan. And Yahoo is that long forgotten search business But Yahoo Japan has been a particularly successful digital initiative partnered with SoftBank in Japan. Last year, $500 million of profit produced by Yahoo Japan. And you get to own those two investments, Alibaba and Yahoo Japan, in the Alibaba holding company or holding vehicle. The assets that they own are priced at about a 25% discount to the net asset value. So there's a degree of safety, there's a margin of protection which gives us ownership of good assets in well-managed, fast-growing businesses. I think great geographic and industrial diversification.
Sure. Bringing it back home, Adrian, at the start of 2018, I remember speaking to a couple of fund managers and everybody was just set and bullish on South African domiciled companies because President Ramaphosa had just taken over the throne and there was an expectation that the new dawn would be realized in 2018. That didn't quite happen, but I suppose that's a conversation for another day. It's 2019 now. In terms of your view of South African companies and their expected performance this year, how are you expecting them to do? And of them, which one are you picking up? Which sectors do you think will fare better than others?
So I think the South African economy and investor aversion will remain the two big headwinds facing domestic assets. There's at the start of the year, there's renewal of conversation about prescribed assets. The ANC manifesto makes reference to the Reserve Bank. So once again, we set ourselves up for some anxiety. That doesn't change the fact that you can buy in the South African market some really well-run, well-priced assets. In the note that we released yesterday, two that we flag are Sabvest, which is Chris Seabrook's investment holding company, and Telkom. So different cap sizes, one sort of quite large cap in the shape of Telkom, 30 billion rand business, profitable, nice return on asset and return on equity, healthy dividend, 5% dividend. So it looks very much utility-like. Sure. That teenage question, is there Wi-Fi? Yeah. Telkom can say yes. But so the valuation of Telkom in and of itself, I think, is attractive. But when you peel back the mask of the top company, there's an underlying asset in the form of a property business called Gyro, which represents 24 billion in property assets. Nowhere in Telkom's share price, we believe, nowhere in Telkom's share price do you see that asset. Right. So you get a well-run, attractively priced utility, telco, and you get the sort of but wait, there's more, in the form of this unpriced property asset, 24 billion on a 30 billion market cap.
And I see that you are suggesting that we could eventually see a Gyro being spun out of Telkom and potentially being listed. All right, even in the event that it does stay in Telkom, you're talking about property, you're talking about landowners. The question around land in South Africa is obviously one that will be spoken about, and especially as we head into the elections. Expropriation without compensation, land reform, how the ruling party plans to go about doing this. We've heard from a lot of investors how, expropriation without compensation, EWC, I think the acronym is hurting investments. So what is the risk to Gyro with this?
I think you have to assess property then, on a case-by-case basis. Their total portfolio references 20 million hectares of property. It's an extraordinary portfolio, 6,500 masts and towers, office centers, client service centers. So it truly is an extremely diverse portfolio, all the way from vacant land through to cell towers. So I think it's impossible to give a single answer on is there anything at risk. I think this is a generic risk to South African land. As far as we understand, there is no specific risk to the Gyro properties. Right. And I think this much is speculation, but our suspicion is that within the next 12 to 24 months, you could see that property portfolio unbundled.
I mean, Adrian, ultimately, the stocks everywhere in most places in the world will be impacted by what the economy does. And just to finish off, let's just talk about the South African economy and expectations for growth for South Africa's economy this year. What do you think about the ruling party's plans to grow the economy?
If your reference is to the manifesto, the
Exactly.
manifesto, that's a wish list. It's this is called politics. It's unsurprising that it's filled with lots of promises, some fantastic proposals about solving real problems for vast tracts of South Africa. It's an election manifesto. And there's a lovely throwaway that I think references the ANC's policy practice. And the suggestion is, don't watch what they say or listen to what they say, watch what they do.
Sure.
And when you look at the ANC policy implementation, their macroeconomic, fiscal and monetary policies are conservative, level-headed, well-balanced, well-judged, and I think that you can anticipate that will flow from what looks like an ANC majority. The real question is really how big a majority, and will it lean in favor of Ramaphosa or in favor of the other camp in the ANC? And that perhaps is the real question in terms of implication for the economy.
Yeah.